Think of credit as the hidden circulatory system of the global economy. It's the essential bridge between capital and businesses needing to grow. When this system operates normally, credit flows at a steady pace, driving predictable economic growth. For decades, U.S. housing prices reflected this stability, increasing at a reliable average of 6% per year. But between 2003 and 2005, the data broke from historical patterns. Housing prices suddenly accelerated, expanding at nearly double that annual rate. This wasn't an economic miracle. This explosive growth was a symptom of a market where credit was flowing too freely, inflating a massive asset bubble. Local banks stopped holding individual mortgages, bundling thousands together into mortgage-backed securities. Banks instantly sold them to investors all over the globe. In this leverage cycle, offloading risk immediately incentivized banks to approve risky loans, moving faster with each cycle. This cycle created a massive vulnerability. The global financial system was heavily leveraged on a single, fragile assumption that U.S. housing prices would never fall. In 2006, the laws of supply and demand finally caught up. Builders had produced so many homes during the boom years that a massive oversupply hit the market. This chart shows the number of new single-family houses sold in the United States. Following the 2005 peak, you can see the data curve plummeting as the market became saturated. As sales vanished, home values dropped. Millions of borrowers were suddenly in a state of negative equity, owing more to the bank than their homes were actually worth. This negative equity triggered a wave of loan defaults and foreclosures that spread across the country. The foundational assumption of the global leverage cycle had been shattered by the reality of falling prices. The defaulted mortgages were embedded inside the mortgage-backed securities held by banks worldwide. Those global assets suddenly became toxic. Systemic panic set in as global financial institutions realized their balance sheets were contaminated with these failing assets. Because no bank knew which other institutions were holding the toxic securities, they completely stopped lending to one another. This lack of trust caused the economy's circulatory system to freeze, drying up the lifeblood of credit. This created a macroeconomic paradox described by John Maynard Keynes. The physical factories were intact, and the workers were still eager, yet the economy stopped producing. The barrier was the frozen credit market. Without access to short-term loans, healthy firms lacked the cash to maintain operations or make payroll. Businesses were forced to lay off millions of workers simply to survive the credit drought. This led to a collapse in aggregate demand. Unemployed workers stopped buying goods, which starves other businesses of revenue, forcing more layoffs in a downward spiral. The failure of abstract financial instruments had directly dismantled the physical economy's ability to function. With private credit frozen and demand in freefall, the government was forced to step in as the lender of last resort. The 2008 and 2009 interventions reached a scale previously unseen in the U.S. economy, incorporating TARP, Quantitative Easing, and massive stimulus packages. These policies were designed to inject cash back into the banking system to thaw the frozen credit networks. The economy operates as a single, highly sensitive web. When excessive leverage breaks the bridge of financial credit, a localized market failure can drag the entire global system into a deep recession.